BlackRock, the company that quietly bought the world. There are companies you hear about every day: Apple, Google, Amazon, Tesla. Their founders are treated like mythic characters. Their logos are everywhere. Their products live in your pocket, in your home, in your car, in your life. And then there are companies you almost never hear about. Companies that don't need attention because attention isn't power, control is. And the strange part is, if you stop 10 people on the street and ask them what BlackRock does, most won't even know. But if you ask BlackRock what they do, the answer is terrifying in its simplicity. They manage money. And not just a lot of money, a scale of money that doesn't feel real anymore. The kind of number you can say out loud without your brain actually understanding it. For a moment, just imagine that money as something physical. Imagine it stacked into bricks, loaded into shipping containers, piled into skyscrapers. Imagine it sitting in vaults and then spreading out like veins into the entire world. The houses you live in, the companies you shop from, the groceries you eat, the energy powering your city, the apps controlling your attention, the wars that move markets, the political decisions that shape economies, the industries that live or die based on capital flows. Here's the real question. If one company sits at the center of that bloodstream, what does that company become? A business or the nervous system of modern civilization? BlackRock didn't buy the world in the way people imagine, like some cartoon villain writing checks and collecting nations like trading cards. It's something far more subtle than that. BlackRock didn't need to storm the gates because the gates were opened willingly, quietly, professionally, often in the name of stability, in the name of efficiency, in the name of saving the economy. And once you understand how the machine works, you start to realize why so many people believe there's no escaping it anymore. Because BlackRock doesn't just own pieces of companies, it sits behind the rules that decide which companies survive. And once you sit behind the rules, you don't need to own everything. You simply need to be unavoidable. BlackRock is often described as the world's largest asset manager, which sounds like a technical label, almost boring, like a title you'd hear in a finance lecture and forget 30 seconds later. That label masks something bigger, because asset managers don't just move money, they move votes, influence, priorities, decisions. They decide where capital goes and where it doesn't. They decide which industries are funded, which technologies scale, which companies are treated like safe bets, which businesses are starved of oxygen. And in a world where money is not just money, but power, controlling the flow becomes a form of invisible governance. If this story was a thriller, BlackRock would be the character who never walks into the room, but the room rearranges itself anyway. The corporation that doesn't need to run for office because it influences the people who do. The giant that doesn't need to conquer territory because it profits from the infrastructure inside it. And the reason it's so difficult to confront BlackRock directly is because BlackRock has a perfect shield, a phrase so clean and so corporate that it dissolves almost every accusation on impact. They say, we don't invest our own money, we invest other people's money. And that one sentence is the difference between being seen as a ruler and being treated as just a manager. But if you manage enough money, eventually you're not just managing portfolios, you're managing outcomes, you're managing reality. And at the center of this story is one man, Larry Fink. Not a celebrity, not a political leader, not someone most people could recognize in a crowd. And yet few humans alive have had a larger effect on the modern financial world. Fink doesn't speak like a villain. He doesn't present himself like one. In fact, the way he speaks is almost comforting. Calm, measured, reasonable. The story begins long before BlackRock existed, before it had headquarters, before it managed trillions, before it became the quiet gravity pulling global finance itself. It begins with a young man who learns something fundamental about the world early in life, something that becomes a permanent hunger. Larry Fink was not born into dynastic wealth. He didn't inherit an empire. He didn't grow up surrounded by boardrooms and private jets. He came from an ordinary background, and like many ambitious people, he discovered that the world has two realities: the one everyone lives in, and the one only a few people get to shape. In the late 1970s, the financial world was transforming. Bond markets were expanding. Complex new products were emerging. Wall Street was becoming less about old money and more about cleverness. Whoever could design the smartest financial tools could print the fastest fortunes. And Larry Fink wasn't just participating in that transformation. He was in the laboratories where it was being built. He entered the bond world and quickly became known for his ability to handle numbers that made other people uncomfortable. He was aggressive, brilliant, ambitious, and like many people who rise quickly, he developed a dangerous sense of inevitability, the belief that success was simply his natural state. Power doesn't come from success alone, it comes from how you respond to humiliation. Larry Fink's early rise was explosive. He became a high-ranking executive early, and in that world, fast ascension can feel like destiny. He worked at First Boston, one of the most prestigious investment banks of the era. He learned the rhythm of the street, the meetings, the deals, the risk-taking, the internal politics, the silent wars for position. And then in a single moment it happened, the kind of moment that either destroys a person or turns them into something else. A major bet was placed, a hedge was calculated, a position was built, interest rates were expected to move one direction and they moved the other. That part happens all the time, but what turned it into a catastrophe was the detail nobody wants to admit in finance, the human element. Miscalculation, the wrong numbers, the tiny mistake on paper that becomes a crater in real life. The loss was enormous, hundreds of millions. In a world where people pretend to love risk, they love blaming someone for it even more. Suddenly, Larry Fink wasn't the golden prodigy anymore. He wasn't the rising star. He was the man attached to the mistake. The one whose name could be whispered in hallways like a warning. The street that had rewarded him for boldness now treated him like a contamination. For most people, that would have been the end. But for Larry, that humiliation became a blueprint. Because he didn't walk away from the trauma thinking, I should stop taking risks. He walked away thinking something colder, more strategic, more permanent. I need to control risk itself. That's the part that matters. Because when a man decides he wants to control risk, he isn't just trying to protect money, he's trying to control the thing that makes people afraid. The thing that makes governments panic. The thing that makes central banks intervene. The thing that forces trillion-dollar decisions overnight. Risk is what moves the world, especially when the world is unstable. So if you can become the one company everyone calls when they're afraid, you don't just become wealthy, you become essential. And essential is the most powerful status in the entire world. Blackrock was created in 1988, not as a flashy investment firm with a glamorous identity, but as something more strategically lethal. A machine built around analytics, discipline, and control. Its roots were in fixed income and risk management. And while other firms chased glory, chased bonuses, chased the fastest deals, Blackrock positioned itself as the calm voice in the storm. It would handle money responsibly. It would monitor danger. It would quantify uncertainty. It would be the adult while others acted like gamblers. In a financial universe driven by fear and greed, that positioning wasn't just smart. It was destined. But it still needed a weapon. And this is where the story takes its first major turn, because Blackrock didn't rise simply by managing money. It rose by building something that became larger than Blackrock itself, something that even its competitors would come to depend on, a system that turned the company from an asset manager into something closer to infrastructure for global finance. The weapon had a name that sounds like it belongs in a sci-fi film, and in a way it does. Not the cartoon version, not a genie, but a software platform, an enormous risk management system designed to model portfolios, analyze markets, and simulate what happens under stress. In simple terms, Aladdin gave Blackrock the ability to do something most institutions could not: see risk faster, in more detail, and across more moving parts than anyone else. It wasn't magic. It was math and computing power, and the discipline to build a system other firms didn't fully understand until it was too late. Here's what made Aladdin different. It wasn't just a spreadsheet. It wasn't just a dashboard. It was a live command center for money. It could take vast portfolios, bonds, stocks, derivatives, mortgage products, currencies, and show institutions how those portfolios would behave if the world suddenly changed. If interest rates moved, if a currency collapsed, if defaults spiked, if markets panicked, if liquidity dried up. Aladdin didn't just monitor risk, it narrated the future in probabilities. And in finance, that is a form of prophecy. At first, Aladdin was a secret advantage inside Blackrock. It helped them win clients. It helped them avoid disasters. It helped them appear smarter, calmer, more prepared. Then Blackrock made a move that turned this advantage into an empire. They began offering Aladdin to others: banks, pension funds, insurance companies, governments. And as more institutions plugged into the same system, something strange happened. BlackRock stopped being just another firm. It became a standard. Once you become the standard, you don't need to beat competitors. Competitors have to orbit you. This is the part most people don't grasp because it doesn't look like conquest. It looks like service. It looks like a company selling software. Once you realize that Aladdin isn't just a tool, it's the underlying architecture of decision-making for huge financial entities, you start to see the darker implication. If enough of the world uses the same financial brain to interpret risk, then whoever controls that brain sits in a position of unimaginable leverage. And then the world delivered BlackRock the perfect gift. Because crises are where power consolidates. Crises are where fear overrides debate. Crises are where governments stop asking, should we, and start asking, who can fix this fast. Crises are where the winners of the next era are quietly chosen behind closed doors, while the public watches headlines thinking it's just chaos. The crisis that turned BlackRock from major player into a global titan was the financial collapse of 2008. The collapse wasn't just a market crash, it was a psychological rupture. People lost homes, jobs, retirements, banks collapsed or were rescued, entire institutions vanished. Behind the scenes, something even more important was happening. The people in charge realized they didn't understand the full risk inside the system. Mortgage products, the derivatives, the tangled exposure, nobody could see it clearly. The financial world had built a monster, and now it couldn't measure its own creature. So they called the firm that specialized in measuring monsters BlackRock. Suddenly, BlackRock was everywhere. Advising, valuing toxic assets, managing emergency programs, helping central banks stabilize markets, being invited into rooms where history was being rewritten in real time. And when you get invited into those rooms often enough, you stop being a contractor, you become part of the machinery. You become someone governments rely on, even when they don't want to admit it publicly. The most important thing about that reliance is that it doesn't go away when the crisis ends. It becomes habit. It becomes dependency. And after the crisis, BlackRock didn't just survive, it grew. And it made one of the most important acquisitions in modern financial history. One that sounds technical, boring even, but quietly placed BlackRock inside nearly every major company on Earth. It acquired iShares, giving it dominance in exchange-traded funds, ETFs. And that was the moment the company's reach became planetary. Because ETFs weren't about picking a few winners. ETFs were about owning everything. When people buy index funds, they're not choosing companies, they're buying the market. That means the fund buys shares in hundreds, sometimes thousands of companies on their behalf. It's passive investing, quiet, automated, constant. And when trillions flow into that system, the firms managing those funds become the largest shareholders across the economy. Not because they wanted to, but because the structure of investing made it inevitable. And BlackRock didn't need to announce dominance. Dominance was built into the math. It now held meaningful stakes in tech giants, banks, defense contractors, pharmaceuticals, oil companies, retail empires across nearly every sector. Not majority control, but enough to matter. Enough to vote, enough to influence corporate behavior, enough to be in the room, enough to make CEOs pay attention when BlackRock speaks. Because if a firm becomes one of your biggest shareholders, you don't ignore it. You can't. And this is where the story becomes disturbing in a way that's hard to explain. Because it's not a conspiracy in the usual sense. It's not a single evil plan written on a whiteboard. It's more like a gravitational phenomenon, a system that concentrates power into certain entities naturally because of how money flows. But once that concentration happens, it creates the potential for something that feels like global control, even if nobody calls it that out loud. Because when a company becomes a shareholder in everything, it doesn't need to run the world loudly. It can shape it quietly through incentives, through capital allocation, through votes, through guidance, through pressure. And that brings us to the real mystery. If BlackRock already has its fingers in everything, what does it want next? Because people don't build machines like this and then stop. They don't acquire influence across governments, markets, institutions, software, and infrastructure just to manage assets. There's always a next layer, a deeper level, a bigger board, and the clues are everywhere. Hiding in corporate language, buried in annual letters, disguised as market opportunities, quietly moving through acquisitions and partnerships. The truth is, BlackRock's next frontier isn't stocks. It's not bonds, it's not even ETFs. It's the physical world, infrastructure. The pipes, the ports, the power grids, the transportation routes, the airports, the water systems, the digital highways that connect the modern planet. Assets so essential that you can't opt out. The monopolies built into reality. Things you don't notice until they fail, and when they fail, everything breaks. And when a company like Blackrock pivots toward infrastructure, it's not just chasing returns, it's chasing permanence, because you can sell stocks in a panic. But you can't sell the water system, you can't sell the road, you can't sell the port that feeds an economy. And once you own pieces of that world, you don't just profit from civilization, you become part of the architecture of it. So the question isn't, did Blackrock buy the world? The question is more unsettling. What happens if it finishes? And what happens when no one can stop it? Not because they're afraid, but because they don't even know where the control begins. Because the true power of Blackrock has never been what it owns. It's what the world has come to depend on. And in part 2, we follow that dependency into the heart of the machine, how Blackrock became the emergency call center of global finance, how Aladdin turned into a financial operating system, how governments began outsourcing decisions to one private corporation, and why the line between asset manager and shadow institution is thinner than anyone wants to admit.
Part 2, The Crisis Contractor. There's a strange pattern in human history, and once you notice it, you can't unsee it. Most powerful entities don't rise when times are calm. They rise when people are afraid, when systems break, when the public demands answers, and the people in charge don't have them. That's when power moves, quietly, quickly, into the hands of whoever can offer certainty in a world that feels uncertain. And in the modern world, certainty doesn't come from speeches or flags or ideology. It comes from risk models, from liquidity, from knowing where the danger is hiding before anyone else sees it. That's why Blackrock didn't just survive the 2008 collapse. It leveled up. Because when the financial system caught fire, Blackrock didn't run out of the building. It showed up with a fire extinguisher and a contract. If you were alive during 2008, you remember the feeling. The atmosphere itself seemed different. People stopped trusting institutions. News anchors used words like meltdown, collapse, contagion. Suddenly, the world looked fragile, like a machine that could snap in half if the wrong lever moved at the wrong time. Banks were falling, credit was freezing, retirement accounts were evaporating, and the terrifying part wasn't just the losses. It was that even the experts couldn't tell you what was happening next. This is the moment where the story stops being about a big company that manages money and becomes about something far more unsettling. Because the crisis didn't just expose greed, it exposed ignorance. The biggest financial institutions on Earth had built products they didn't fully understand, stacked them into structures too complex to unwind, and then sold pieces of that structure across the world. Mortgage-backed securities, collateralized debt obligations, layers on layers on layers of risk disguised as safety. It was finance as architecture, but the foundation was made of sand. When the sand collapsed, everyone realized they didn't know what was inside the rubble. So the most powerful people did what they always do when they don't understand something. They outsourced. They didn't outsource it to a university. They didn't outsource it to a public institution. They outsourced it to the one company whose entire business model was built around one thing: measuring risk at scale. Blackrock. The same Blackrock that had built a system capable of simulating the behavior of massive portfolios under stress. Aladdin. And in that moment, Blackrock became something it hadn't been before. Not just a participant in the system, but an emergency technician called in to diagnose the system itself. And here's what most people don't realize. When you're called in to clean up someone else's mess, you learn where the bodies are buried. You learn who was reckless, who was lying, who was exposed, who would collapse if the truth came out. In a crisis, information becomes more valuable than money, because information lets you predict the next move. It lets you position yourself ahead of the stampede. It lets you become the trusted actor in a world where trust is evaporating. Blackrock didn't just help institutions understand their toxic assets. It learned how the entire machine was wired. And once you understand the wiring, you can influence the circuit. In public, the story sounded simple. The government was trying to stabilize the economy. Central banks were trying to prevent collapse. Regulators were trying to restore trust, and BlackRock was simply a contractor, hired because it had expertise. But beneath that version is a darker question, the kind that doesn't get asked in official press conferences because it feels almost impolite, almost taboo. The question is, what happens when a private company becomes so technically essential to crisis response that governments can't function without it? Because at that point, BlackRock isn't just working for the government, it's working inside the government's operational bloodstream. In normal times, government decisions move slowly, committees, approvals, negotiations, politics. But in a collapse, there is no time for perfection. There is only time for action, and whoever can act fastest becomes the gatekeeper of survival. In 2008, the decisions being made weren't just financial. They were existential. Banks could fail within hours. Markets could cascade within minutes. The government needed rapid solutions, valuation models, purchasing programs, liquidation strategies, and BlackRock's specialty wasn't ideology. It wasn't partisan politics. It was speed and risk intelligence. So BlackRock became the company you call when the world starts shaking. Not because anyone voted for it, not because laws mandated it, but because in those moments, expertise becomes authority, and authority becomes power. That's the first transformation, but the second transformation is where things become almost cinematic. Because BlackRock didn't just gain influence through emergency consulting, it gained something more permanent, a relationship with the architects of money itself, the Federal Reserve, the Treasury, the regulators behind closed doors. When BlackRock shows up in a crisis, it doesn't show up at the edge of the room. It shows up at the center. It becomes the translator between government panic and market reality. It becomes the technician with the map. And if you're the only one in the room who can read the map, you can decide which direction the convoy goes. For a moment, imagine this from inside the Fed. Markets are collapsing. Everything is on fire. You're trying to stop the bleeding without knowing how deep the wound is. You need a tool, something to analyze portfolios, to run scenarios, to tell you what happens if you inject liquidity here instead of there. You need to know which assets are toxic and which are just misunderstood. You need to know what happens if you bail out institution A but let institution B die. That's a terrifying level of decision-making. And so you bring in the firm that can model the consequences, BlackRock. And suddenly, BlackRock's software, BlackRock's people, BlackRock's analytics, those become part of the government's nervous system. This is how power becomes invisible. It doesn't arrive like an army, it arrives like a consultant. A consultant doesn't just advise. A consultant shapes the menu of options. Even when a government makes the final decision, the consultant's analysis influences which choices feel safe, which choices feel too risky, and which choices feel inevitable. In a crisis, the most persuasive voice is the one saying, "This is the mathematically responsible move." And if you're the entity producing that math, you aren't just participating, you're scripting reality. Then the crisis ends, markets stabilize, people exhale, and everyone assumes the relationship will reset, that BlackRock will go back to being a firm among firms. But that's not how the real world works. Relationships formed under fear don't disappear. Dependencies created in chaos become habits. BlackRock becomes the company that gets called again and again and again, until calling BlackRock is no longer a decision, it's reflex. And this is where Aladdin stops being a tool and becomes a monopoly disguised as software. People often hear the word software and think of harmless products, apps, platforms, dashboards, something you can uninstall if you don't like it. But Aladdin isn't an app. It's an operating system for institutional money. Once your portfolio systems are integrated, once your compliance reporting relies on it, once your risk culture is trained around it, leaving isn't just difficult. Leaving can become dangerous. The people running these funds fear being the one who turned off the system that everyone else uses, especially when markets get unstable. So they stay. And staying creates more data, more dependency, more standardization, more gravitational pull. And gradually, something becomes true without anyone formally declaring it. If you manage big money, you use Aladdin. Aladdin doesn't just calculate risk for BlackRock, it calculates risk for other major institutions. It helps pension funds manage retirements for millions of people. It helps insurers manage long-term liabilities. It helps banks understand their own exposures. It becomes the quiet infrastructure underneath the global economy, like plumbing, like electricity, like highways. People don't talk about it because it's not glamorous, but if it fails, everything breaks. And when a private company owns the plumbing of global finance, you have to ask a question that sounds paranoid until you realize it's logical. Who regulates the plumbing? Because most people think financial regulation is about markets, but the markets are now shaped by systems that sit outside traditional regulation. A software platform can influence behavior without moving a single dollar itself. It can define what risk means. It can define what safe means. It can define what institutions consider acceptable exposure. If everyone relies on the same models, the same stress tests, the same assumptions, then a hidden uniformity emerges across the financial world. And uniformity can be deadly. It creates a system where everyone reacts the same way at the same time. And when everyone runs for the exit simultaneously, that's how collapses accelerate. In other words, a system designed to manage risk can, under certain conditions, become a machine that amplifies it. So the irony is brutal. The company that built its empire on risk management becomes so influential that its systems themselves become systemic risk. And yet, BlackRock as an asset manager has often argued that it isn't systemically important in the same way a major bank is. Banks hold deposits, banks lend money, banks can create credit shocks. Asset managers, they say, merely manage assets on behalf of clients. And that technical framing matters because it affects regulation, oversight, and scrutiny. It affects whether BlackRock is treated like a utility or like just another firm. Because the whole BlackRock model is built around separation. The money isn't theirs, the assets aren't theirs, the decisions are theirs, but the risk is distributed. So whenever critics say BlackRock owns everything, BlackRock can respond with something clean and corporate. We are fiduciaries. We invest on behalf of clients. And legally, that's often correct. The deeper truth is different. Ownership isn't the only kind of control. Voting power matters, influence matters, the ability to reshape corporate priorities matters. And when a firm becomes a top shareholder in thousands of companies, even with single-digit percentages, it starts sitting above the economy like a weather system. It can't individually micromanage every company, but it can shape the climate in which companies operate. It can decide what kinds of governance are encouraged, which executive teams are rewarded, what kinds of shareholder proposals succeed, which deals get greenlit, which strategies are seen as aligned with long-term investor interests. And the moment you realize this, you start to understand why some people call BlackRock a shadow government. Not because it controls everything directly, like a dictator, but because it can bend entire industries indirectly, like gravity. Now, there's another element to this story that most people miss, because it doesn't show up in flashy headlines. BlackRock doesn't just grow through investments in software. It grows through personnel, through the invisible human pipeline between private power and public power. The revolving door. Same phenomenon that makes citizens cynical, because it feels like the game is rigged. People go from government to finance, finance to government. Regulators become executives, executives become policymakers. And somewhere inside that loop, the line between public interest and private advantage becomes blurry. So the question becomes, does BlackRock influence government because it's powerful, or does it stay powerful because it has influence in government? And once you see it like that, it stops feeling like a conspiracy. It starts feeling like architecture. Now you might be thinking, okay, fine, maybe BlackRock is huge, maybe it's influential, maybe it's deeply connected, but isn't that just capitalism? Isn't that just how modern finance works? And that's exactly the point. The terrifying part isn't that BlackRock is doing something illegal in the open. The terrifying part is that it doesn't have to. The system allows this concentration. It rewards it. It accelerates it. The public doesn't stop it because the public doesn't even understand it. And most politicians don't stop it because their entire economic system relies on the stability BlackRock helps maintain. So BlackRock becomes untouchable, not through intimidation, but through dependence. And then slowly, almost invisibly, the company changes again. Because in the beginning, BlackRock's empire was mostly financial: bonds, equities, index funds, passive investing. But there's a ceiling to that kind of power. If you only own paper assets, you still exist one layer removed from the physical world. You can influence markets, but not necessarily the daily necessities of human life. And that's when the next move begins. The one that makes critics lean forward and say, this is where it gets dangerous. Because if you can't opt out of financial markets, that's one kind of captivity. But if you can't opt out of infrastructure, that's another. You can choose not to buy certain stocks. You can choose not to invest in ETFs, but you cannot choose not to use roads. You cannot choose not to drink water. You cannot choose not to rely on energy grids. You cannot choose not to live somewhere. You cannot choose not to depend on supply chains unless you're willing to abandon modern life entirely. Infrastructure is the skeleton of civilization, and the skeleton is where the real power hides. What makes infrastructure so attractive to giant capital isn't just profit, it's inevitability. If an airport exists, people must use it. If a port exists, goods must pass through it. If a power grid exists, the entire region depends on it. These are monopoly-like assets by nature. They don't compete the way products compete. They dominate by existing. And that dominance creates stable cash flows, tolls, fees, long-term contracts, government payments, service agreements. These deals often last decades. That's not investing in a trend, that's investing in permanence. And once BlackRock fully understands this, once Larry Fink understands it, the story stops being about ownership in companies. It becomes about owning the invisible arteries of the world. Before we get to that, we have to talk about something else BlackRock learned from 2008. It learned that crises don't just create fear, they create acquisitions. In normal times, buying something massive is hard. There's competition, there's negotiation, prices are high. But in a crisis, everything becomes cheap. Companies become desperate, governments loosen rules, competitors collapse, and the strongest players, the ones sitting on liquidity and credibility, get to choose what they want from the wreckage. And BlackRock became one of the strongest players. So while the world was focused on the collapse, BlackRock was quietly expanding. It acquired, it absorbed, it positioned itself as the safe harbor. And when the smoke cleared, it wasn't just surviving, it was larger, more embedded, more essential, more connected, and more politically protected than ever before. It had become the company you call in chaos, and the company you trust in stability, which is the rarest and most dangerous combination of all. Because when you are trusted in stability, you make money, and when you are trusted in chaos, you make history. So by the end of this era, BlackRock has achieved something no financial empire dreams of openly, but quietly builds toward. It becomes too integrated to challenge, too important to exclude, too connected to regulate easily, too widely trusted to accuse without sounding extreme. And that's why the story becomes so difficult to tell in public. Because the moment you point at BlackRock, people say, yes, but the markets need them. Yes, but pensions rely on them. Yes, but stability matters. Yes, but if they fail, we all fail. And that's exactly the trap. When a private company becomes so embedded that its failure becomes unthinkable, it has effectively gained a kind of immunity. Not legal immunity, systemic immunity. And once you have systemic immunity, you can expand into territories that would otherwise be politically impossible. Which brings us to the next phase of the story. The part where BlackRock stops acting like the world's biggest asset manager and starts acting like the world's biggest infrastructure strategist. Because if Aladdin is the operating system of finance, then infrastructure is the operating system of life. And in part 3, we follow BlackRock into the physical world, ports, airports, pipelines, power grids, and the billion-dollar deals that quietly reshape nations, not by conquest, but by contracts. And we'll ask the question at the center of the entire mystery. If BlackRock isn't just managing money anymore, what exactly is it building? Part 3, Owning the Arteries. There's a moment in every empire's rise when money stops being enough. When numbers on screens, even trillions of them, begin to feel abstract, too distant from real power. Because financial dominance is powerful, yes, but it's still mediated. It still depends on markets opening, systems functioning, trust remaining intact. Real control, the kind that lasts through crises and regimes and wars, has always lived somewhere else. It lives in the physical world, in land, in routes, in choke points, in things people cannot avoid. And once BlackRock reached the peak of financial abstraction, once it had woven itself into the portfolios of nearly every major institution on Earth, the next move became inevitable. Larry Fink didn't want to just manage the world's money anymore. He wanted to anchor it. Infrastructure sounds boring until you realize what it really means. It's not just bridges and roads and power lines. Infrastructure is the skeleton of civilization, the arteries through which everything flows. Goods, people, electricity, water, data. It's the invisible layer that decides whether an economy thrives or suffocates. And unlike tech startups or consumer brands, infrastructure doesn't compete. It dominates by existing. There's only one main airport per region, one major port, one water system, one grid. Once you control it, you don't need to win customers. They come to you because they have no choice. This is the kind of asset Wall Street has always dreamed of. Stable, predictable, long-term, inflation-resistant, and most importantly, politically sensitive. Which is why, for most of modern history, infrastructure was handled by governments. But in the last few decades, something shifted. Governments began selling pieces of themselves, not out of ideology but desperation. Blackrock was watching, at first cautiously. Infrastructure investing requires patience. But once Blackrock reached a size where patience and scale were no longer obstacles, the logic snapped into focus. This wasn't just another asset class, this was the end game. Because when you own infrastructure, you don't just profit from growth, you profit from existence. Larry Fink began speaking about it more openly, though still in the language of finance. Structural demand, long-duration assets, stable cash flows. Behind those phrases was something far more direct. The world was already primed for this shift. Decades of underinvestment had left infrastructure brittle. And into that vacuum stepped firms like Blackrock, offering a deal that sounded almost too good to refuse. Let private capital rebuild public systems, and everyone wins. But everyone is doing a lot of work in that sentence. Because infrastructure privatization doesn't just change who owns assets, it changes incentives. A public water system exists to deliver water. A private water system exists to deliver returns. Those two goals overlap until they don't. Maintenance becomes a cost, upgrades become optional, service quality becomes negotiable. And when contracts run 20, 30, sometimes 50 years, the long-term consequences are invisible at the signing ceremony. Blackrock understood this dynamic better than most. Not because it was malicious, but because it was rational. Infrastructure, once privatized, creates something close to a monopoly. You don't compete on price when there's no alternative. This is not the messy chaos of consumer capitalism. This is rent extraction, legalized and contractual. So BlackRock began positioning itself not just as an investor in infrastructure, but as the partner governments should trust to design, finance, and manage it. This is where the company's earlier strategy pays off. Decades of advising governments during crises, deep relationships with central banks, alumni scattered throughout regulatory agencies. And then came the acquisition that made the shift unmistakable. In early 2024, BlackRock announced it would acquire Global Infrastructure Partners, GUP, for roughly $12.5 billion. On paper, it was just another deal, but in reality, it was the largest signal yet of BlackRock's true ambition. This wasn't diversification, it was consolidation. BlackRock already influences corporations through financial ownership. It already shapes markets through ETFs. It already advises governments through crisis management. Now it directly controls physical assets that entire populations rely on. This is not just economic power. This is leverage over daily life. And once you understand that, you start seeing BlackRock's fingerprints everywhere. Airports. Think about airports, not just as places where planes land, but as choke points of globalization. Whoever controls major airports controls tourism, business travel, logistics, even national security implications. Ports are even more powerful. Ports decide how goods flow. Fuel, electronics, medicine. In a global economy, ports are arteries. Block them, and economies choke. Pipelines, power grids, data infrastructure, these aren't neutral assets. Which brings us to one of the most symbolic and controversial examples of this shift, the Panama Canal. The canal isn't just a waterway. It's one of the most important trade routes on Earth, a narrow strip of infrastructure that determines how trillions of dollars in goods move between oceans. For decades, its control has been a geopolitical issue. And while governments argue loudly about sovereignty and influence, BlackRock operates in a quieter register. When Blackrock-linked entities began moving into port infrastructure connected to the canal, it didn't look like conquest. It looked like business. And that's the genius and the danger of the model. There are no tanks, no flags, no declarations, just ownership. This is the same pattern repeated across the globe. Infrastructure assets quietly shifting from public hands into private portfolios managed by institutions so large that reversing the deal becomes politically and economically impossible. Because once a pension fund's returns depend on toll roads or water systems or airports, opposing that infrastructure model means opposing retirees. BlackRock doesn't need to threaten anyone. The system threatens itself. And then there's war. War has always been the ultimate accelerator of infrastructure opportunity. Destruction creates demand. Demand attracts capital. Capital demands guarantees. And this is where BlackRock's strategy reveals its most unsettling dimension. Post-war reconstruction isn't just about rebuilding. It's about deciding who owns the future of a country. When BlackRock began positioning itself at the center of Ukraine's post-war reconstruction planning, it wasn't random. It was preparation. Reconstruction is infrastructure on steroids. Massive sums, political urgency, international funding, weak bargaining positions. Perfect storm for private capital to lock in long-term control under the banner of recovery. And the model is elegant. Public money absorbs risk. Private capital captures upside. Governments guarantee returns to attract investors. BlackRock manages the funds, the projects, the flow. Everyone gets to claim victory. Politicians say they rebuilt the nation. Investors say they supported stability. And BlackRock quietly becomes embedded in the country's future, owning stakes in the systems people will depend on long after the headlines fade. This isn't unique to Ukraine. It's a template. Every flood, every war, every grid failure becomes a market. And the firm best positioned to capitalize on those markets is the one that already sits at the intersection of finance, policy, and physical assets. This is why critics are uneasy, because infrastructure is different from stocks. It's not liquid, it's not flexible, it doesn't move easily. Once privatized, it stays privatized, unless governments are willing to spend enormous sums to buy it back. And history shows they rarely do. Instead, they regulate around it, negotiate with it, accommodate it. The asset manager becomes a permanent stakeholder in the nation's core functions. So when Larry Fink talks about structural demand, he's not wrong. The world genuinely needs trillions in infrastructure investment. But the question isn't whether investment is needed. The question is who controls it and under what conditions. Because when infrastructure is run for profit, equity becomes optional. Access becomes a pricing decision, maintenance becomes a negotiation, and the public loses leverage. You can protest a politician, you can vote out a government, but how do you vote out a 30-year infrastructure contract? How do you hold a global asset manager accountable when its shareholders are scattered across the planet? This is the quiet paradox of BlackRock's rise. It operates within the rules of the system, while slowly reshaping what those rules mean in practice. It doesn't overthrow governments. It partners with them. It doesn't abolish public institutions. It integrates with them. It doesn't declare dominance. It makes itself indispensable. And that's why resistance is so fragmented. Environmental groups criticize it for fossil fuel exposure. Conservatives attack it for ESG influence. Progressives worry about privatization. Regulators debate its size. But these criticisms pull in different directions. There's no unified opposition, just noise. And BlackRock continues building. Because while everyone argues about ideology, BlackRock is acquiring assets. Now the question that lingers, like a low-frequency hum you can't quite escape, is this: what happens when one company becomes too embedded to fail, too essential to replace, too large to regulate effectively, and too quiet to mobilize against? What happens when the arteries of civilization are managed by entities whose primary obligation is to investors, not citizens? And perhaps the most uncomfortable question of all, what happens when the next crisis hits? When the next war erupts, when the next climate disaster unfolds, when the next financial shock ripples through the system, who will be called to help? Because history suggests the answer is already written. And in Part 4, we follow the final layer of the machine: the moral authority, the public narratives, the ESG era, the backlash, and the quiet retreat, and why BlackRock's most dangerous power may not be financial or physical at all, but psychological.
Part 4. the invisible hand that lectures. Power doesn't always show up wearing armor. Sometimes power shows up wearing a suit and a smile and a perfectly worded press release. Because once an empire becomes large enough, it no longer needs to intimidate openly. It can persuade, it can influence, it can frame reality. And in the modern world, the most effective form of control isn't telling people what to do, it's telling them what's responsible, what's sustainable, what's good governance, what's the future. And when a company that already owns pieces of nearly everything starts telling the world what the future should look like, people either call it leadership or they call it dangerous. This is where Blackrock's story becomes much more than finance, because at a certain point, Blackrock stopped acting like a silent index giant in the background. It began stepping forward slowly with a new tone. A tone that didn't sound like Wall Street greed, it sounded like moral authority. Larry Fink, the CEO, began issuing annual letters, not just to investors but to CEOs across corporate America. These letters weren't written like typical corporate fluff, they were written like a manifesto. Calm, confident, almost paternal. The message was always something like this: we are long-term investors, we care about stability, we care about risk, and the world is changing, so companies must change too. On the surface, it sounded reasonable, even inspiring, but under the surface there was a subtle power move embedded in every sentence. Because when the world's largest asset manager speaks, it's not really speaking as an opinion, it's speaking as a pressure system. Imagine you're the CEO of a major company. You're responsible for thousands of jobs. Investors watch your every move. Regulators are waiting for mistakes. One wrong quarter and your stock crashes. Now imagine a firm that owns a meaningful slice of your company, maybe not 51%, but enough to matter, sends you a letter implying what your priorities should be. Maybe it's climate. Maybe it's diversity. Maybe it's board governance. Maybe it's stakeholder capitalism. Whatever the topic is, the message lands with an invisible weight, because even if the letter says we encourage, everyone hears we expect. And that's how Blackrock shifted from being a financial empire to being a cultural force. It wasn't just managing capital. It was shaping what corporate virtue looked like, defining what responsible investing meant, framing social priorities as investment priorities. And once those two merge, once morality and capital become intertwined, you get a new kind of authority. Authority that doesn't require votes or laws or even arguments. It just requires influence. This era has a name most people now recognize: ESG, environmental social governance. At its best, ESG is a genuine attempt to align capital with long-term human survival. To acknowledge that climate change isn't a political debate, it's a risk. That public trust matters. That corruption destroys markets. That badly governed companies eventually implode. But at its worst, ESG becomes something else. A branding mechanism, a marketing strategy, a justification for higher fees, a set of vague promises that sound good in public while portfolios remain mostly unchanged in practice. And Blackrock, whether intentionally or inevitably, became the face of the ESG era. Larry Fink spoke about sustainability like it was the next industrial revolution. He positioned climate as an investment risk that markets could not ignore. He hinted that companies refusing to adapt would be left behind. In some cases, Blackrock's voting behavior and shareholder engagement reflected that tone, pushing companies towards certain disclosures, certain commitments, certain frameworks. And for a while, it looked like a transformation was happening. Wall Street was evolving, capitalism was growing a conscience, the largest firm on earth was becoming the adult we needed. But then reality collided with the narrative, because there was always a contradiction sitting in the center of this entire ESG moment. Blackrock could speak about climate while holding enormous positions in fossil fuel companies. It could speak about responsibility while profiting from passive investing that owns everything, including the things it claims to challenge. It could promote ethics while its core business model was designed to be neutral: buy the market, track the index, collect the fee. This created a strange public tension. Environmental groups and climate activists began calling Blackrock a hypocrite. They argued that it was too powerful to hide behind neutrality, that if Blackrock truly believed climate was existential, it would move capital away from fossil fuels more aggressively. And BlackRock, in response, would point to its fiduciary duty, its role as an asset manager, the need to balance returns and risk. The conversation became a mirror maze, everyone accusing, everyone defending, nobody fully convincing. The bigger crack wasn't coming from environmentalists, it was coming from politics. Because once ESG became a cultural signal, it became a battlefield. And BlackRock found itself trapped in the worst possible place, the center of the culture war. In the eyes of many on the left, BlackRock wasn't doing enough. Too much fossil fuel exposure, too much hypocrisy, too much greenwashing. In the eyes of many on the right, BlackRock was doing far too much. Using money to push ideology, forcing companies to adopt woke positions, interfering with free markets, acting like an unelected political actor. And this is where the story becomes almost poetic in its irony. BlackRock was attacked for being both the villain and the savior. When you're attacked from both sides, you begin to realize something about being the most powerful firm in the world. Visibility is dangerous. For decades, BlackRock's true power came from being invisible, from being the giant behind the curtain, but ESG dragged it into the spotlight. Suddenly, ordinary people were saying its name. Politicians were using it as a talking point. Protesters were showing up at offices. Governors were making statements. Journalists were digging into ownership structures. BlackRock, the quiet machine, was becoming a symbol. Symbols are where empires get hurt. So what did BlackRock do? It didn't fight loudly. It didn't panic publicly. It did something far more strategic. It adjusted quietly, because that's BlackRock's specialty. At first, the ESG messaging softened. Then it became less central, then it became more ambiguous. Then gradually the company stopped using the term as much. Larry Fink himself, once the loudest voice in the room about ESG, began speaking differently. Less certainty, less public moral leadership, more emphasis on choice, client preference, energy security. The language shifted like a ship changing direction in fog, slow enough that most people wouldn't notice, but deliberate enough that insiders could feel it. The company didn't need to announce a retreat. It simply stopped pushing forward, and the numbers told the story more honestly than the speeches did. Support for certain shareholder proposals dropped, votes changed, the boldness faded. And if you were paying attention, you could almost hear the logic inside the machine. ESG has become expensive. Not financially expensive. BlackRock can handle pressure. Politically expensive. Brand expensive. Operationally expensive. Because the more visible BlackRock becomes, the more it invites scrutiny into the deeper parts of its empire. And ESG was a spotlight. It was a debate that made people ask what BlackRock was doing, why it was doing it, and who gave it the authority to force behaviors across corporate America. That phrase, force behaviors, became one of the most haunting lines associated with the company. Because it implies something very important. It implies that BlackRock knows it has power, not just passive ownership, not just we track the market. It implies that when BlackRock wants to influence direction, it can. And once you accept that as true, you begin to reevaluate everything else. You begin to wonder what influence looks like when it's not loudly branded as ESG. What happens when BlackRock stops trying to shape morality and starts shaping infrastructure? What happens when it stops shaping corporate policies and starts shaping nations? Because ESG was never the real prize. It was a costume, a phase, a tool. The real prize is something even more powerful than culture and politics combined, necessity. And necessity lives in the physical world. If BlackRock is criticized for ESG, it can retreat. If BlackRock is criticized for climate hypocrisy, it can reframe its messaging. If BlackRock is attacked politically, it can reduce visibility. If BlackRock owns and controls essential infrastructure, airports, ports, power systems, then criticism becomes meaningless because nobody can simply cancel a water system. Nobody can boycott a national grid. Nobody can boycott the airport their region depends on. Nobody can boycott the supply chain that brings medicine and food. That is the kind of power that outlives public outrage. That is the kind of power that doesn't need to win arguments. It only needs to function. So the ESG era for BlackRock served as something else too, something almost like a lesson. It taught them where the world reacts, where the resistance forms. It showed them the cost of visibility. It exposed their vulnerabilities, public perception, political backlash, media narratives. And once you learn your vulnerabilities, you don't panic, you evolve. This is why the most unsettling part of the Blackrock story isn't the company's size, it isn't even its influence, it's the adaptability. The way it shifts its language and posture without changing its fundamental trajectory, like a predator that doesn't chase when it doesn't need to, it simply waits, repositions, and continues. While ESG dominated the headlines, something else was happening beneath the surface. Infrastructure deals, strategic acquisitions, quiet partnerships, long-duration contracts, the movement toward physical control, the movement toward the arteries of civilization. So when people say BlackRock is taking over the world, the truth is they might be saying it in the wrong way. It's not a hostile takeover. It's not one big plan revealed in a dramatic movie scene. It's a slow absorption of systems until resistance becomes irrelevant. The more you study BlackRock, the more you realize it doesn't need to convince you it's powerful. It needs to convince governments it's useful. It needs to convince institutions it's safe. It needs to convince investors it's stable. And it needs to convince the public it's too complex to talk about. That's the ultimate shield. Complexity, because complexity creates fatigue. Fatigue creates indifference, and indifference is the permission slip for consolidation. That's how power grows in the modern age. Not by force, by paperwork, by finance, by solutions, by being the entity everyone turns to when things are broken, by becoming the default option. And when the default option becomes embedded in the system begins to belong to it. So the story now reaches a crossroads. BlackRock has achieved financial dominance. It has built a global risk operating system. It has shaped corporate behavior. It has experienced backlash and learned to retreat. And now it has moved toward infrastructure, the physical backbone of civilization, which means the next phase is no longer about what BlackRock owns. It's about what BlackRock becomes. Because once you control both finance and infrastructure, you begin to resemble something that doesn't fit neatly into any existing category. Not a bank, not a government, not a tech company, not a utility. Something new, something that operates above and below society at the same time. And in part 5, we reach the turning point of the entire documentary, the moment where the story stops being a warning and becomes a question. Because if BlackRock is now embedded in governments, markets, infrastructure, and crisis response, then who exactly has authority over it? And what happens if the world finally decides it wants its control back?
Part 5, the empire no one voted for. There's a concept most people think they understand until it disappears. Sovereignty. We grow up believing sovereignty is something nations possess by default, like gravity, that governments control borders, that elected leaders control policy, that public institutions control public resources, that when something goes wrong, the state can intervene, protect people, stabilize the system, and enforce rules. It's comforting. It's the mental foundation beneath modern life. But sovereignty isn't just a word. It's a function. It has to be maintained, protected, exercised. And in the modern era, sovereignty doesn't collapse with tanks crossing borders. It can collapse in silence, through contracts, acquisitions, and the quiet outsourcing of national power. That's what makes the BlackRock story so haunting. Because if you strip away the headlines, the culture wars, the protests, the memes, the viral clips about the company that owns everything, what remains is something far more serious. A reality where a private corporation, answerable to shareholders, not citizens, becomes embedded so deeply inside the modern world that governments begin to behave less like rulers and more like customers. It doesn't happen in a single dramatic moment. It happens the way all system takeovers happen now. It happens politely. At first, it looks like normal capitalism, a firm managing assets, a firm buying stakes, a firm offering solutions. You'd think the limit is obvious. Surely governments would intervene if a private firm became too powerful. Surely regulators would step in. Surely laws would prevent a corporate entity from quietly becoming a central nervous system for global finance. But here's the paradox. The bigger BlackRock becomes, the harder it is to regulate it, because regulating it becomes destabilizing, and destabilizing it becomes politically suicidal. So even people who dislike BlackRock's power find themselves trapped in the same logic. The world is dependent on it, and dependency is the deepest form of control. It's easy to imagine power as domination, orders, threats, commands, but modern power is often the opposite. It's the ability to make people need you, to make alternatives feel impossible, to make to make your presence seem like the safest option, even to those who resent you. BlackRock didn't just grow large, it grew foundational. And once something becomes foundational, you don't fight it, you accommodate it. That's what makes this feel less like an ordinary corporate story and more like the rise of an empire no one voted for. Because there is no election for global asset managers. There is no referendum on whether pension funds should be indirectly tied to infrastructure privatization. There is no public debate on whether the financial operating system of major institutions should be owned by a single private entity. These shifts happen behind closed doors, inside technical meetings, through financial arrangements that the average citizen never sees and would never be taught to understand. And yet, those citizens live inside the consequences. So here's the question that defines this entire phase of the story. If BlackRock is not a government, but it performs functions governments rely on, what is it? Because it isn't a bank, at least not in the traditional sense. Banks take deposits, issue loans, create credit. BlackRock typically doesn't. It's an asset manager managing funds for clients. That legal definition is the shield. It allows the firm to say, again and again, we are not the owners, we are fiduciaries. But in practical terms, in the real world where influence is more important than labels, BlackRock behaves like something else, a meta-institution. An invisible policy actor, a stabilizer, a kingmaker, a system administrator for global capitalism. And that's why critics argue that traditional regulation is outdated, because it targets the wrong thing. It targets the visible institutions, the banks, the lenders, the insurers. Meanwhile, the new centers of power operate in forms that don't trigger the same alarm systems. They don't fit into old categories. They live between the lines, between ownership and control, between public and private, between markets and governance. This is not about one villain pulling levers behind the curtain. It's about a system that rewards consolidation until it becomes unavoidable. And BlackRock, whether by strategy or by inevitability, became the ultimate expression of that system. Now, when people attempt to confront BlackRock's power, the confrontation almost always hits the same wall. The wall has two words: passive investor. That phrase is one of the most important and least understood weapons in modern finance. Passive investing is marketed as humble, neutral, non-interventionist. You're not picking winners, you're not actively trading, you're simply tracking an index, owning the market. It sounds almost innocent, and in some ways it is. Passive investing democratized access to markets. It lowered fees, it made diversification easier, it changed the way the middle class invests. But here's the twist. Passive investing doesn't reduce power, it concentrates it. Because when everyone invests passively, the same few firms end up owning large slices of everything. The market becomes their product, the world becomes their portfolio, and the more passive money flows, the larger their voting power becomes. Their influence becomes a structural feature of capitalism, not an active choice. It's like building a city where every road leads through the same bridge, and then acting surprised when the owner of that bridge becomes powerful. So, when regulators look at BlackRock and ask, "Are you systemically important?" BlackRock can say, "We're passive. We don't control companies. We just reflect the market. We don't create risk. We manage it. We don't lend. We don't take deposits." And technically, much of that is true. But power doesn't care about technical truth. Power cares about outcomes. If BlackRock can influence corporate governance across industries, that's power. If BlackRock can shape which reconstruction projects get funded, that's power. If BlackRock can partner with governments to design infrastructure pipelines, that's power. If BlackRock's systems are used by central banks during crisis stabilization, that's power. And once a firm reaches that level, the argument about whether it's passive starts to sound almost absurd. It's like saying a weather system is passive because it doesn't intend to cause storms. It still shapes the climate. So then the obvious question becomes, why hasn't BlackRock been treated like a too-big-to-fail institution? Why hasn't it been regulated the way banks are? Why hasn't it been forced into stricter oversight? And here we reach another uncomfortable reality, one that many people suspect but few say out loud cleanly. Regulation is often reactive, slow, and political. It's shaped by lobbying, by relationships, by narratives. And BlackRock is not just good at finance. It is good at being seen as essential. Essential firms can negotiate their oversight. Essential firms can shape the conversation. Essential firms can frame scrutiny as a threat to stability. And stability is the sacred word governments fear losing. So when people talk about who controls BlackRock, they often look for a single authority, a regulator, a law, a committee, something visible. But control doesn't work that way anymore. It's distributed, fragmented, jurisdictional, complicated, and BlackRock's operations are global, a multinational web. It exists across borders while regulation remains national. That mismatch is the gap where modern corporate empires grow. Now here's the most chilling part. When empires rise, they don't only accumulate assets, they accumulate plausible deniability. They build layers, legal, technical, institutional, so that any accusation can be answered with, "It's not that simple." And often it isn't. The modern world is complicated. Finance is complicated. Ownership structures are complicated. But complexity is also the perfect camouflage for consolidation. So the question becomes, what would stopping BlackRock even look like? Would it mean breaking it up? But how do you break up an asset manager that manages money for millions of people through thousands of funds across countless markets? Would it mean regulating Aladdin? But how do you regulate software that sits inside hundreds of institutions and is often treated as proprietary technology? Would it mean restricting infrastructure ownership? But governments themselves invite private capital into infrastructure because they need the money, because voters resist taxation, because political cycles reward short-term solutions. The system is built to invite exactly this outcome, which means if the world wants to reverse it, it would require something rare in modern politics: long-term thinking, coordination, and courage. And those are precisely the things the modern world struggles to produce. So BlackRock continues, not because it is unstoppable in a physical sense, but because stopping it would require collective action, and collective action is expensive and slow. Meanwhile, BlackRock's strategy is disciplined, continuous, and technologically reinforced. It doesn't need to convince everyone. It only needs enough institutions to keep feeding the machine, and the machine feeds itself. Assets under management grow. Growth brings more influence. Influence brings more relationships. More relationships bring more deals. More deals bring more assets. And the cycle repeats. There's another layer, something colder, something closer to inevitability than strategy. Because BlackRock isn't the only giant. Vanguard exists, State Street exists, other global firms exist. And the rise of these mega asset managers isn't just a BlackRock story. It's the story of a world where capital became so large, so global, so interconnected that it had to concentrate in order to move efficiently. The world demanded scale, and scale created giants. So the danger isn't just BlackRock, it's what BlackRock represents: a new model of power, a model where democracy controls politics, but capital controls systems, where governments govern people, but corporations govern infrastructure, where elections decide cultural direction, but asset managers decide economic reality. And when you live in that world long enough, you start feeling something the public can't always name, but can always sense: that the system is rigged, that someone else is steering, that you are being managed, not represented, that your life is connected to decisions made in rooms you will never enter, by people you will never meet, using models you will never be able to audit. That's where paranoia is born, not from fantasy, from helplessness. And yet, even here, we have to be careful, because it's easy to turn this story into a simple villain narrative. BlackRock is evil. Larry Fink is the real president. It makes for powerful clicks, powerful rage, powerful fear. But the truth is always more complicated. BlackRock didn't invent the world's financial system. It didn't invent global capitalism. It didn't invent the public's demand for cheap investing. It didn't invent government budget failures. It didn't invent underfunded infrastructure. It exploited these things, yes, but it didn't create them. And in a way, that makes the story even darker. Because if a system naturally produces entities like BlackRock, then BlackRock isn't an anomaly. It's a symptom, a perfectly engineered product of the world we built. So the ending of this documentary can't simply be "and then they win." Real life isn't a movie. In reality, empires don't fall because one hero exposes them. They fall because the public decides the cost of the empire is too high and demands a new model. Sometimes that demand comes through regulation, sometimes through technology, sometimes through political movements, sometimes through crisis. Because crisis is always the reset button history eventually presses. And if history has taught us anything, it's this. Systems that cannot be challenged peacefully eventually get challenged violently. So if the world wants to avoid that future, the question becomes urgent. Can a society build infrastructure without selling its sovereignty? Can a nation fund stability without outsourcing control? Can financial markets remain efficient without concentrating power into a handful of invisible giants? Can democratic governments regain enough strength to steer their own systems? Or is the future already decided because the money already moved? Because if Blackrock truly has embedded itself into the world's arteries, finance, infrastructure, crisis response, then the story isn't just about a company quietly buying the world. It's about the world quietly letting itself be bought. And that is the kind of ending that doesn't feel like an ending at all. It feels like a warning. Part 6, The World After Ownership. The most dangerous thing about modern power is that it doesn't feel like power anymore. It feels like normal. It feels like a phone screen lighting up in your palm. It feels like tapping a card at a grocery store. It feels like your paycheck landing in an account you don't really think about. It feels like water coming out of a faucet, electricity humming through walls, packages arriving at doors, airplanes crossing oceans. It feels like the world is simply functioning. Because it functions, we assume someone is in control. Someone must be steering it. Someone must be accountable. But what if no one really is? What if the world isn't being governed the way we imagine, but managed the way a portfolio is managed? That's the real horror behind the Blackrock story. Not the numbers, not the trillions, not the headlines. The horror is the idea that the modern world has quietly traded governance for management, citizenship for stakeholders, and sovereignty for contracts. That we are living inside a system where power moved away from the visible institutions we argue about and into invisible systems we don't even know how to name. Blackrock didn't take over the world with violence. It didn't need to. The modern world doesn't collapse by force anymore. It collapses by convenience, by short-term fixes that become long-term dependencies, by political paralysis that invites private solutions, by crises that demand immediate action. And every time the world panics, it searches for the same thing: competence, stability, someone who can handle it. BlackRock built its entire empire around being that someone. Because if you can convince the world that you are the safest pair of hands in chaos, then chaos becomes your opportunity. If you can become the default operator of risk, then risk becomes your currency. And when you grow large enough, you no longer need to win debates. You don't need to run campaigns. You don't even need to be loved. You only need to be necessary. That's the highest tier of power in the modern age: necessity. And necessity is what BlackRock chased step by step, year by year, crisis by crisis. First it was the bond markets, then risk management, then a software empire that turned into a financial operating system, then the crisis response relationship, quietly becoming the emergency contractor for governments and central banks. Then iShares, passive investing, the ability to own pieces of everything without looking like you were trying to. Then ESG, moral leadership, the idea that BlackRock could shape corporate behavior, not just through money, but through virtue. Then the backlash, the retreat, the rebranding, and then infrastructure, the part of the story that stops being financial and starts being physical. Because at that point, the shift becomes irreversible. Owning stocks is influence. Owning infrastructure is reality. Stocks can crash, markets can change, a company can rise and fall, but a port remains, an airport remains, a pipeline remains, a grid remains, a water system remains. Whoever sits closest to those assets sits closest to human life itself. At the end of this documentary, the truth is not that BlackRock is some cartoonish villain twirling a mustache while plotting world domination. The truth is colder, more neutral, more unsettling. The truth is that BlackRock is what happens when capitalism becomes so advanced, so automated, so global, so concentrated, that it begins to resemble a governing force. Not because it declares itself one, because the system treats it like one. And that leads to the final question. The question that hangs in the air once the credits roll. If BlackRock is not elected and not accountable, and not easily replaceable, then who checks it? Because that's what sovereignty is at its core: the ability to enforce limits, to say no, to draw boundaries, to keep power from concentrating so far that people become helpless. And in the modern world, governments still say they have sovereignty. But sovereignty means nothing if the public sector can't maintain infrastructure without private capital. Sovereignty means nothing if central banks can't stabilize markets without calling in a private firm. Sovereignty means nothing if public pensions depend on the profits of infrastructure privatization. Sovereignty means nothing if the only way to keep the machine running is to keep feeding it. And you can feel that tension building under the surface of modern society, even if nobody says it out loud. People don't trust institutions. They don't trust media. They don't trust politicians. They feel that decisions are being made somewhere else, somewhere unreachable. And when people feel unreachable decisions controlling their lives, they start searching for answers in extremes: conspiracies, rage, hopelessness. Because at least conspiracy gives a face to the invisible. But here's the uncomfortable twist. Even if you took Blackrock out of the picture tomorrow, the world would still produce another Blackrock. Because the demand is structural, the incentives are structural, the fragility of modern systems is structural. Blackrock thrives because governments need money, because pension funds need stable returns, because people want low fees and safe investment products, because infrastructure is crumbling, because public budgets are strained, because markets are too complex, because crises are constant, because the world is interconnected, because global capital needs managers, and whoever manages the most capital becomes the most influential, whether anyone intends it or not. So if this story has any meaning beyond fear, it's this: the threat isn't a company. The threat is a world that has quietly accepted a model where the most powerful institutions are invisible. A world where policy can be shaped without politics, where control can be exerted without conquest, where ownership can be distributed in ways that still concentrate influence, where freedom becomes theoretical because the systems you depend on are privately managed. And yet, history doesn't end here, because something always happens when power concentrates too far. The public notices, not immediately, not cleanly, not politely, but eventually. And when the public notices, one of two things happens: either the system adapts peacefully or it breaks violently. That has been the pattern for centuries. So what would peaceful adaptation even look like? It would mean governments reclaiming their ability to build infrastructure without surrendering it. It would mean new rules around monopoly-like assets and public necessities. It would mean transparency in the systems that define risk and stability. It would mean examining whether passive ownership can be allowed to become a default governing structure for entire economies. It would mean forcing the modern world to answer a question it has avoided for decades. Should essential systems exist primarily to generate profit, or primarily to serve people? Because the moment you ask that question sincerely, the whole framework begins to shift. The moment you treat infrastructure as public sovereignty instead of private opportunity, the deals become different. The moment you treat risk management software like a utility instead of a proprietary black box, the oversight becomes different. The moment you treat crisis response as a public function instead of a private contract, the future becomes different. This requires something rare. It requires the public to see clearly, to resist distraction, to resist the comfort of simplistic villains, to resist the illusion that the world is controlled only by politicians and headlines, and to recognize that power in the 21st century is quieter than ever, but no less real. Larry Fink once described Blackrock's mission in language that sounded responsible, even noble: helping people retire, managing risk, building long-term value. And it's true, there are teachers, nurses, working families whose pensions flow through systems Blackrock manages. There are ordinary people who indirectly benefit from stable investing. This is what makes the story morally complex. Blackrock is not simply a predator feeding on the world. It is also, in many ways, the system keeping the world from falling apart. And that is exactly what makes it so hard to confront. Because how do you fight something that is both the symptom and the medicine? How do you oppose a system that creates stability while also concentrating power? How do you criticize an entity that can genuinely argue it is doing what the world demanded? That's why this story doesn't resolve with a clean villain defeated. It resolves with an uneasy truth. The world created Blackrock by rewarding the kind of power Blackrock represents. And now the world has to decide whether it still wants that kind of power. Because if we do nothing, then the next phase of this story is predictable. More infrastructure, more integration, more dependency, more quiet consolidation, more political paralysis, more crisis contracting, more privatized necessity. And gradually, the world will reach a point where the question who runs the world becomes almost meaningless, because the world will not be run in a traditional sense. It will be administrated, optimized, risk-managed, packaged, and sold, until life itself becomes something that produces predictable cash flows for those who own the systems behind it. Maybe the most haunting part is how invisible this transition can be. Because when you wake up in the morning and the lights turn on, when the water runs, when the internet loads, when the package arrives, when the grocery store is stocked, you don't feel like you're living inside someone else's machine. You feel like you're living in normal life until one day something breaks. Shock hits the system, a war, a crash, a blackout, a supply chain failure, a debt crisis, a climate disaster, and suddenly you realize the world isn't as stable as you thought, and the same question returns like a ghost: who will save it? And if the answer is always the same, then the empire doesn't need to conquer the world. The world will keep handing itself over, piece by piece, until there's nothing left to hand over. So the final message of this documentary isn't Blackrock is coming. Blackrock is already here, not as a monster hiding in a cave, but as a mirror of the world we built. A world where the most powerful institutions operate in silence, where control looks like expertise, where domination looks like service, where ownership looks like management, and where the line between public life and private profit grows thinner every year until it disappears completely. And if that sounds like paranoia, if that sounds dramatic, then you're hearing the story exactly the way it's meant to sound. Because when power becomes invisible, the first step to surviving it is noticing it, even if, for a moment, it makes you uncomfortable.